Hello everyone and thank you for watching Edupedia World videos. In today's class we are going to do the unit 4 of chapter 1, that is concept of previous year and assessment year. So this is the last unit of chapter 1, and after we finish this unit we will be done with all the basic concepts that we require to know to understand the subject of taxation. So let's just proceed with our class today. So, first of all comes the learning objectives for this unit, the unit of concept of previous year and assessment year. What are the learning objectives of this unit? Number 1 is the meaning and relevance of assessment year and previous year. We'll get to know in this class of today the definition and meaning of the term assessment year and previous year. What do we mean by assessment year and previous year in the context of Income Tax Act 1961? How does the Income Tax Act defines assessment year and previous year, and moreover we'll just understand and learn the relevance of these two terms, how much importance they hold in this whole subject of taxation. They hold a very important place in this subject, so we need to understand these concepts very clearly. Second is, what is previous year for undisclosed sources of income. We'll get to understand what are undisclosed sources of income and what is the previous year for these types of income. Generally, previous year is defined, and in these exceptional cases the previous year is defined. So we need to differentiate between them and understand them very clearly, that what is the definition of previous year in general phenomenon and general terms, and what is the definition of previous year in these exceptional cases. And the third and the last one is circumstances when income of the previous year would be assessed to tax in the previous year itself. First of all, when we'll know the definition, understand the definition of assessment year and previous year, we'll understand that these are two different terms and the tax is paid in the assessment year. We'll get to know the definition in the coming slides, but for now on I'm telling you that an assessee is required to pay tax in the assessment year. So when there are circumstances when the assessee is required to pay the income tax in the previous year itself. So we'll learn those circumstances and we'll get to know those circumstances. So these are the three learning objectives for today's unit. Number 1, the meaning and relevance of assessment year and previous year. What do they mean and what relevance they hold? What is previous year for undisclosed sources of income? There are few undisclosed sources of income, and what is the previous year for them? And last, the circumstances when the income of the previous year would be assessed to tax in the previous year itself. That is, the assessee will be liable to pay the income tax in the previous year itself rather than the assessment year. So let's proceed with today's class, and let's start with our first learning objective, that is meaning and relevance of assessment year and previous year. Meaning of previous year and assessment year. What do we mean by previous year and assessment year? So let us go through each and every point one by one, and then we'll be able to understand it in a better way. The balance sheet and income statement of assessees are usually prepared for a period of 1 year. Whatever business we are doing and whatever profession we are in, we have to prepare our income statement for a period of 1 year. And from when does this period start and when does it end? In India, this 1 year starts from April 1 and ends on March 31 of the following year. So, if I am in any business, I have to prepare my accounts for a period of 1 year, starting from 1st of the April and ending on 31st March of the following year. So, if I am preparing accounts for the year 2012-13, my balance sheet and income statement will be from April 1, 2013 to March 31, 2014. Similarly, 14-15, I am preparing my statements for 14-15. So that will include my incomes from April 1, 2014 to March 31, 2015. So this way we just prepare our financial statements for a year. An year in India means, a financial year in India means starting from April 1 and ending on March 31. So this period in which income is earned is known as the financial year or the previous year. So this span of 1 year in which I am earning income and I am preparing my financial statements for that year, so that is my financial year, and in income tax terminology it is also termed as previous year. Okay, so this is what we mean by previous year. Now in the next slide we'll just understand the meaning of assessment year, and then we'll connect both the terms and understand these terminologies in a better way. The income tax returns are filed and taxes are usually paid in the next year after the end of the financial year or previous year. Now, we have prepared our income statements for the year, suppose starting from 1st April 2013 to 31st March 2014. My income statements are prepared for this year, this previous year, that is starting from 1st April 2013 and ending on 31st March 2014. So I will be liable to file my income tax return following the financial year or the previous year 13-14. So this next year in which income is assessed to tax is called the assessment year. So the assessment year for the income earned between 1st April 2013 to 31st March 2014 will be the year of 14-15. That will be the assessment year for the previous year 13-14. So this is how it works. So if the accounts are being prepared for the period of April 1, 2013 to 31st March 2014, this period will be called the financial year or the previous year 13-14. And this income would be assessed to tax in the next year, and this period will be called as assessment year 14-15. So now you understand the concepts of previous year and assessment year. The year in which the income is earned is called the previous year, and the year in which that income is assessed to tax and the assessee is liable to pay tax is the next year, that is the year following the previous year, which is called the assessment year. This is the meaning of the terms previous year and assessment year, and this is how they work in the Income Tax Act. I earn income in 1 year and I pay tax on that income the next year. The year in which I am earning is the previous year as per the IT Act, and the year in which I am paying taxes on that income is the assessment year, which is the year following the previous year in which the income was earned. Now this table will help us understand the concept of previous year and assessment year in a more proper way, and the concepts will be more clear. So just have a look on this table. It has 4 columns. Number 1 is year starts on, that is when is the year starting. Number 2 is year ends on, when is the year ending. So what will be the previous year and what will be the assessment year. If the year is starting on 1st April 2012 and ending on 31st March 2013, the previous year for this span of time will be 2012-13, and the assessment year will be the year following the previous year will be 2013-2014. Got it? Next is year starts on 1st April 2013, year ends on 31st March 2014. So the previous year for this span of time will be 2013-14 and the assessment year will be 2014. 2014-15. Year starts on 1st April 2014 and it is ending on 31st March 2015. So the previous year for this span will be 2014-15 and the assessment year will be just the year following the previous year, that is 2015-2016. Okay, so you all have understood the concept of previous year and assessment year. Now let us take few examples and illustrations to just make this concept more clear. Number one, first illustration is Mr. A is running a business from 1993 onwards. Determine the previous year for the assessment year 2015-16. So now in this question, the first line of the question is not relevant for the answer, just because the question is asking the previous year for the assessment year 2015-16. So it does not matter when did A started running business. We just have to answer and we just have to know what will be the previous year for the assessment year 2015-16. So assessment year is the year following the previous year and previous year is the year just before the assessment year. So what will be the previous year for the assessment year 2015-16? It will be 2014-15. 2014 starting from 1st April 2014 and ending on 31st March 2015. So the previous year for assessment year 2015-16 will be 2014-2015, that is starting from 1st April 2014 and ending on 31st March 2015. The second example is a chartered accountant sets up his profession on 1st July 2014. Determine the previous year for the assessment year 2015 and 2016. So here, the chartered accountant is starting his profession on 1st July 2014. So that is not relevant. That okay, if he is not starting his practice on 1st April and rather he is starting his practice in the middle of any previous year, that is 1st July, still the assessment year will be the year following the previous year. So what will be the previous year for the chartered accountant? It will be 2014-15, starting from the previous year 2014-15 normally starts from 1st of April, but here as he is setting up his practice on 1st July, so his previous year will be from 1st July 2014 to 31st March 2015. So okay, we have found out the previous year and what will be his assessment year. His assessment year will be the year just following the previous year, and that will be 2015-2016. Okay, the previous year will be the year in which he started practice, irrespective of the fact that he started on 1st April or not. He started on 1st July, so his year will also start from 1st July. So his previous year will be 1st July 2014 to 31st March 2015, and the assessment year will be from 1st April 2015 to 31st March 2016, that is 2015-16. Now we come to the topic of previous year for undisclosed sources of income. We have discussed the journal terminology of previous year, and now we'll discuss about undisclosed sources of income. What do we mean by undisclosed sources of income? The income which I am earning and which I am not disclosing in my return of income and which I am not disclosing to the government is the income which is undisclosed. So what will be the previous year for that? The Income Tax Act contains certain provisions for such sources, such undisclosed sources of income. What are these undisclosed sources of income and how they are treated and how they are taxed? We'll discuss that. There are many occasions when the assessing officer detects cash credits unexplained investments, unexplained expenditure, etc., the source for which is not satisfactorily explained by the assessee to the assessing officer. What happens is that I am investing a huge amount of money in shares or in real estate or whatever be the case, and I am expending a huge sum of amount in say my daughter's marriage or my son's marriage or whatever be the thing. I'm expending a huge sum of money, and when I'm asked to explain that from where did I get so much of money to invest into, or from where did I get so much of money to expend, I'm not able to satisfy the assessing officer. The assessing officer is not satisfied by the reasons or by the sources of income which I'm giving. Then what happens is that the assessing officer charges that income to the to income tax, and the assessee has to pay income tax on that amount, that amount which he has invested or the amount which he has expended. If he is not able to perfectly satisfy the assessing officer the source of such investment and the source of such expenditure, that is, where did he get so much of money, what was the source, from where did he get so much of money to invest into or to expend, so that unexplained investment and unexplained expenditure will be charged to income tax, and the assessing officer will make the assessee to pay income tax on such investment and such expenditure at a higher rate also. So let us discuss these cash credits, unexplained investments, unexplained expenditure in detail in the coming slides. First comes the cash credits, the unexplained cash credits under Section 68 of the IT Act. What happens is that, let us first read the text and then I'll make you understand it in detail. Where any sum is found credited in the books of the assessee and the assessee offers no explanation about the nature and source, or the explanation offered is not satisfactory in the opinion of the assessing officer, the sum so credited may be charged as income of the assessee of that previous year. What does this section say is that, suppose I am running a business and I am showing in my books of account that I have taken a loan of rupees 20,000, and that is reflecting in my books of account as cash credits, that I have taken a loan uh, of rupees 20,000, and that is reflecting in my books. And when I'm asked to explain the nature of the loan and the source of the loan, I'm not able to offer any explanation about the nature and source. I'm not able to explain about where did I get the loan from, who is the lender, what is the rate of interest he is charging me, or whatever be the case. I'm not able to explain it. Or the explanation which is offered by me is not satisfying the assessing officer. The assessing officer is not satisfied by the explanations given by me about the nature and source of the credit. So what will happen is that the sum so credited may be charged as income of the assessee of that previous year. That credit in my books of account which I am showing as loan or whatever be the case, that can be charged as my income for that previous year. Though that is not my income for that year. That is just a loan or some credit, cash credit, which I have taken from someone to invest in my business. But if I'm not able to offer a reasonable explanation about the nature and source of the loan, then that will be treated as my income for that previous year, and that will be charged to income tax. So this is what is cash credit. Now this is a very important point regarding cash credits. So let us first read the point and then I'll make you explain what does it mean or what is it trying to convey. Any explanation offered by a closely held company in respect of any sum credited as share application money, share capital, share premium, or such amount by whatever name called in the accounts of such company shall be deemed to be not satisfactory unless the person, being a resident in whose name such credit is recorded in the books of such company, also explains to the satisfaction of the assessing officer the source of sum so credited as share application money, share capital, etc. in his hands. Otherwise, the explanation offered by the assessee company shall be deemed as not satisfactory, consequent to which the sum shall be treated as income of the company. So, this is a very, I know the text is very confusing, so let us understand it point by point. What is a closely held company, first of all? A closely held company is a company which is being managed by only few people and relatives. The company only consists of few people, say less than 20, and all those are closely related to each other. It means it's not a public company in which the public is interested at large. It is a small company. We can't say small. It's a company in which the people who are involved at higher positions are related to each other. They know each other, and they are the only ones managing the company, and nobody else. So, closely held company is a company in which fewer people are involved, and those people are connected to each other, they know each other, and in which the public is not interested at large. So, a closely held company is a that company. So, what this point is saying that if such type of company in which the public is not substantially interested at large, if that company in those accounts, in this closely held company's accounts, if any sum is credited as share application money, share capital, share premium, etc., meaning that they are showing in their books of account uh, some money as share application money, like they have issued shares, and for that they have received money as share capital, meaning the same, that they have issued shares of their company and they have received money for that shares, and that is showing as credit in their books of account. So, and if they in the accounts of such company, and the assessing officer just tells the closely held company to explain that what is the source of this money. So they will to say that they have issued shares and receive money. So what happens in this case, that the assessing officer will question the people in whose name the share application money is recorded in the books of account of that closely held company. Say if I am investing, my name is there in their books of account as Ramesh, and I've given share application money 20,000. So my name is appearing in their books of account like I have given this sum of money to the closely held company in the form of shares, a share application money. I have subscribed to their shares and I have given money to them. So the assessing officer will question me that from where did you get this amount to invest in this closely held company? So, not just the closely held company will be questioned, the person in whose name the credit is there in their books of account, that person will also be questioned that from where did he get the money, the nature and source of the money which he has invested in that closely held company. And if I am not able to satisfy the assessing officer that what was the nature and scope of the nature and source of the money which I am investing in that closely held company in the form of share application money, then also that money, that share application money, the credit will be treated as the income of that closely held company. If the share subscriber like me is not able to perfectly satisfy the assessing officer that from where did I manage to get that money to invest in the company, then the closely held company will be liable to pay tax on that cash credit, because that credit will be treated as their income just because I was not able to satisfactorily explain to the assessing officer that from where did I manage to get the money. So this is a very important point in respect of a closely held company. If they are showing any money as share application money in whosoever names, and that whosoever is not able to satisfy the assessing officer the nature and source of that money, then that cash credit will be treated as the income of the closely held company, and they will be liable to pay income tax on such money. This provision is very important because it happens that small companies show in their books of account as share application money such large amounts, and they just tell that we have just issued shares and people has subscribed and we have got the money, but in reality this is not the case, and in thus black money is generated. So this provision has been inserted by the Income Tax Act so that the closely held companies are brought under the lens and the money is properly taxed, that the person in whose name the credit is appearing, if he or she is not able to satisfy the assessing officer that from where did they get the money to invest in such a closely held company, then the closely held company will be taxed for such cash credits. Now comes the unexplained investments under section 69, where in the financial year immediately preceding the assessment year, the assessee has made investments which are not recorded in the books of account, and the assessee offers no explanation about the nature and the source of investments, or the explanation offered is not satisfactory, then the value of the investments are taxed as income of the assessee of such financial year. Okay, so what happens is that this is the assessment year going on, and in the previous year, in the previous financial year, I invested in some say property or in gold or whatever be the type of investment. I made such investments and which I did not record in my books of account. I just we can say that we hid it from the government and we are not showing it to the government. So we are not recording it in the books of account, and um, by chance or by investigations, the assessing officer came to know that we have made such investment in such things, and they will then just ask for an answer and explanation of the nature and source of such investment. First of all, we what mistake or what sin we did is we did not record it in the books of account, and secondly what we did is that we did not offer any explanation about the nature and the source of investment. When we are being asked, we are not able to explain that from where did we get such money to invest it in these investments, or when we are explaining it to the assessing officer, the assessing officer is not satisfied by our explanations. He is not satisfied that such was the nature of the money, or such was the source of the money from where which we invested in the investment. So what he'll do is that the value of such investment will be included in our income for that year, and that will be taxed as income of the assessee of such financial year. So these are the consequences of not recording any investment in the books of account, and consequently just getting it taxed as income for that year. Whenever we are investing, we should reflect it in the books of account, or if we are not reflecting it in the books of account, but when we are being asked about the nature and source of such investment, we should explain it properly and satisfy the assessing officer. And if we are not able to do that also, then that investments will be charged as income of the previous year in which we invested. Now third is the unexplained money etc. under section 69A. We are done with cash credit section 68. Then came unexplained investment section 69, and now is unexplained money under section 69A. where in any financial year the assessee is found to be the owner of any money, bullion, jewelry, or other valuable article, and the same is not recorded in the books of account, and the assessee offers no explanation about the nature and source of acquisition of such money, bullion, etc., or the explanation offered is not satisfactory, the money and the value of bullion, etc., may be deemed to be the income of the assessee for such financial year. The same what we did in unexplained investment. We invested in something and we are not recording it in the books of accounts, and when we are asked, we are not explaining satisfactorily to the assessing officer, then that investment is charges income for that year. Similarly, we are the owner of any money, bullion, jewelry, or other valuable article, and we are not recording it in the books of accounts, and when we are asked, we are not offering any explanation, or the explanation offered is not satisfactory, then such monies and such bullions, jewelries, and other valuable articles, whatever we are possessing, will be deemed to be the income, our income for such financial year. The procedure is same in all the cases, that is, the thing which we are possessing or the thing which we are investing, if we are not recording in the books of account and we are not offering any proper explanation, satisfactory explanation, then that will be the income, our income for that year, and that will be taxed to income tax. Here, one thing more is there, that ownership is important and mere possession is not enough. For example, I am in possession of some jewelry or monies, but I am not the owner of that jewelry. I am just possessing it in behalf of someone else. So, the person who is possessing it will not be charged, rather, the person who is owning it will be charged for that money and bullions or jewelry, whatever may be the case. In the next class, we'll do the remaining learning objectives of this unit, that is, the remaining undisclosed sources of income and the topic of certain cases when income of a previous year will be assessed in the previous year itself. Okay, thank you, students.